Hello, this is Cryptolyze. I hope you are well on this Sunday, 24 September 2023. We meet today to talk BTC, to talk crypto as usual, except that BTC and crypto are between two waters, are on the edge of the cliff to potentially retest the 20,000. Hello, this is Cryptolyze. I hope you are well on this Sunday, 24 September 2023. We meet today to talk BTC, to talk crypto as usual, except that BTC and crypto are between two waters, are on the edge of the cliff to potentially retest the 20,000 or even lower. The bull run is still relatively far away, and we often ask ourselves the question of how we manage this type of situation, which are emotionally complicated to manage, how we manage our portfolio, how we manage our exposure overall, how we manage our risk, and it will be the subject of this video, and it starts right away. As I told you, BTC is stuck between two waters. Overall, we are after a very strong expansion phase at the start of the year 2023. We have a macro, which is in a contraction phase, as we could see in the previous videos where we have the S&P 500, which is in the process of retracing the NASDAQ. We know that we have bonds which are in the process of being revalued. So we do not necessarily have a strong attraction for risky assets and therefore cryptos and BTC. So we are in an area which is a little complicated, and we know very well that it is going to take a little time. We know very well from the past that we are going to take time as here. We can see it in the different moment where we see that we also have an acceleration and then a retracement of a breath, which was very long, in which we then had an upward acceleration. Reciprocally, also in the years 2015 minus 2016, the same, we had this bearish breakout, lateralization, breathing acceleration, and there we will find ourselves a little bit in the same dynamic in this phase of lateralization and lethargy, which we will certainly store away for a while. We're going to stay in something that will look like this. And so there we ask ourselves the question of how we manage our risk, how we manage the current situation. Namely, that we can also ask ourselves the question of how BTC will behave in the face of a situation which is inflationary, in a situation in which we have high rates and which are potentially heading towards a small recession. For those who follow the channel a little, you understand exactly what I'm trying to explain. So here we are in the process of defining ourselves. Is yes or no here, this zone really a classic ranging zone? Or are we going to be in a dynamic to say, are we going to look for a lower point before rebuilding? Are we going to hunt for lots? Are we just going to bounce back in the 20,000 to start moving up again? This is the question we are going to ask ourselves today. It is also the question of risk management. It's not so much what BTC is going to do that is important. It's how we are going to react to each situation, and you will see that it is important. First of all, you have to understand the first thing, exposure. Understand what exposure is and how you are exposed. Overall, it's quite simple. That is to say, in relation to your investment portfolio or your cash flow, they are two things which are separate, but both are taken into account. How many exposure do you already have? Do you have, for example, on 100% of capital, therefore, on $100, do you have $40, which are directly integrated into BTC and other cryptos, and therefore 60 in cash? Therefore, at that moment, you have a 40% exposure. If you're rather the opposite, 60% in crypto and 40% in cash, you have an exposure of 60%, and the exposure varies several things. Varies one on your cash flow, implying how much you are capable of investing every month by. Example, if you have a capital of 100 and every month you add 10, this implies that the following month you have a capital which is 110. Okay, so your exposure will vary. If here we were in an exposure of 40%, so implies $40, which was positioned here in crypto well, that implies that there it will be more than 40% because it will be $40 on $110, and therefore your exposure decreases. So it's something that fluctuates and that fluctuates in addition to the price of cryptos, okay? Understand that if now you are at 40% when the BTC will be around $15,000, if one day it gets to $15,000, once again, at this moment, your exposure will be different because your cash, $1 will remain. $1, so it will not move. Your cash will remain like that. And next to it, your share of the BTC will do that okay. So that sub understands that the propensity of the dollar will increase relative to that of crypto, and therefore inevitably your exposure will decrease. So these are things that are important to understand because you will have to reevaluate your exposure in relation to the different courses, and systematically, ideally, you set a date. And in relation to your situation, obviously there is no perfect rule. There is no rule that suits everyone, but there is a need to think about what we expose ourselves to, particularly risky assets like cryptocurrency, in which, yes, we can have big performances, but also behind big descents. We experienced this fall well here. Here I am in logarithmic, which is why we see that the fall is not that strong. But if we check carefully from the top to the a low, we still did less than 78%. So it's something that is difficult to live with. If someone had put $100 here on top of the pile, they would have ended up with less than $25 here. Understand that it's complicated to manage. It's complicated to manage emotionally, and that's why exposure is very important. How would I have experienced this fall if I was exposed to 100% versus someone who was exposed to maybe 10%? The feeling is totally different, and we know very well that emotion is the very heart of the decision. This implies that emotion leads to a decision which is rarely good. We know it well. It's written everywhere. Everyone talks about it. On the other hand, being able to manage it is not just about meditating yourself. No, we are very far from that. It's going to be something that's very factual. It's exposure. What risk am I taking from market volatility? Overall, this is the question you need to ask yourself. From what percent you are able to assimilate a fall, and from what percent you are able to assimilate, because we are talking about the decline, but also on the rise, the feeling of FOMO, that is that, here, let's admit we don't do any lower. Okay, we stay there and we do a high acceleration thing, which is quite unlikely, but we take it into consideration. Like that's something which is really very erratic with an upward acceleration. Let's admit Tesla reaccepts BTC and all ETFs are validated, and Tesla says that they are going to buy 100,000 BTC to make a crypto investment fund. In short, whatever, we would also have an acceleration. How would you react to the exposure you have now? Do you think you missed the train? Are you saying to yourself, it's okay, I'm on the train? Or do you say to yourself, well, that's it, I'm 100% in? The same reciprocally, if ever. Here we have catastrophic news, for example, Binance, which is collapsing, and BTC, which is banned in the United States. How do you manage the fact of finding a BTC potentially at 10,000 or 5,000? How do you react? Is this something that will be complicated to manage? Is this something that will be acceptable? The notion of saying to yourself, I have invested the money, I am ready to lose it. We should avoid engaging in this particular course of action. While we are aware that investing in such ventures carries a certain level of risk, we must refrain from assuming that our investment will inevitably be lost. Instead, we should focus on effectively managing the emotions that may arise from this situation. It is important to consider the proportion of our investment in relation to our overall capital, regardless of whether we have invested $5,000, $10,000, $100,000, or even $1 million. In general, in my financial situation, this is why I tell you that it is specific to each person, and the emotional part is specific to each person. Personally, I have a rule which is around 60%. I know that when I am in a lateralization phase, which is a phase like that, this type of zone in which we are going to have an oscillation, on that I will continually try to stay at 60 minus 65% maximum exposure, in which I know that I am exposed but not overexposed. I know that if we go lower, I will have a reinvestment capacity, which will be relatively important. I also know that I have a cash flow capacity, which is also very important. I know that I have the ability to systematically rebalance the different cryptos that are part of my portfolio. And so that's why I have this rule, but it's a rule that's specific to me and that's really specific to my functioning. And this is where the notion of investment versus trading is very important. They are two things that are separate. Generally, when we make an investment, it is rather long-term, in which we will make rebalancings which are less frequent. And when we do a little of both, we tend to make rebalancings which are more frequent, especially in a period of uncertainty like this, where we can have strong breaks. Very fast, in which we will want to cut losses, and that is why we must take into consideration that exposure matters for investment, but also for trading. We must separate the two accounts. Have an account which will be finally a pool of capital which will be dedicated to investment, and a pool of capital which will be dedicated to trading. And precisely use the trading pool for everything that is speculative, and the investment pool manage it in a rather classic form of exposure, in which we will do arbitrage, for example, every week, every month, every 2 months, every 6 months, depending on the time you have given to managing your portfolio. We really need to separate the two. We shouldn't create a big melting pot because many do it. We need to have a speculative allocation. Trading, if you ever want to do trading and a long-term investment allocation with a policy and a strategy which is different, it is the temporalities which are different, and a notion of exposure which are different. And the same in your risk management, take care. Consideration of temporality, for example, trading is something that is rather liquid, in which we will have positions that are relatively short. Investment is relatively long. What is your outlook on life? Do you want to buy a house, for example, in 6 months, a year, 2 years? Do you have any special purchases? Do you have a safety mattress large enough to absorb, for example, a change of car or a move? In fact, all these vectors, all these factors are essential in the design of your own investment plan and your own risk management. There is no perfect answer, but in fact, there is a set of elements to understand in order to compose it. And above all, ask yourself all these questions. At what moment? If this happens, how will I react? If this happens, how will I react? And try to sometimes even go to extremes, to imagine yourself in situations that are complicated to manage, to know what your limits are and what your good zone is. And once again, ask yourself your goal questions. What is your objective? What temporality? And at that point, you will have your risk management. And to know that risk management evolves enormously at the level of people, but also at the level of time. This means that as time passes, your risk management will become more refined. The more your risk management will evolve because perhaps your cash flow will change, perhaps your objectives will change, but also, quite simply, the asset itself, BTC, will change. We talk a lot about liquidity injection, we talk a lot about ETFs, and we talk about very risky assets, BTC, but know that BTC is now considered a non-risky asset in all cryptos. It is a very risky asset because it is a crypto. But among all cryptos, it is considered to be a lower risk vector. And the same precisely in the weighting of your portfolio put a significant part of BTC and Ethereum. For example, which are the two values, a bit of a refuge, BTC much more anyway, in which at that moment we know that we are going to reduce the risk of losses on your risky pocket, therefore, which is the crypto pocket. And that is where we are going to start to enter into a notion of risk management according to different people. The more we will want to have volatility, the more we will move towards altcoins to know that, as usual, we are careful, because the more we seek return, the more we exposes himself. At risk, there is not in fact one without the other, it is necessarily one with the other. And therefore, the more we go towards altcoins, the more risks we will take, but the more this risk to report. Afterwards, there is a question of choice. There is a question of exposure in relation to, am I exposed to 1 asset, 2 asset, 10 asset, 40 asset? At this point, over-diversification and under-diversification are also vectors of risk. Well, that's perhaps another subject, another video, but you have to understand that here, we are in a situation where, yes, we can very well sink as well as we can very well come back up. The important thing is how you are going to handle this part. How are you going to handle your situation? Because when we look and zoom out in the long term, in fact, one and the other, we have something that is in a very bullish trend. Okay, but the problem is rarely the long term. The problem is always the short term. How do we react in the short term? How do we react in the medium term? How do we react when we are in an upward acceleration? Same, we talked about downside exposure, but it's the same. An exhibition can also be managed upwards. Obviously, when the short will make big green candles and which will rise very quickly, very strongly like that. We will have the crypto potential, which will increase in relation to your cash, and therefore at that moment you will have an exposure which will increase. And therefore, you will have to define rules. What will be your rules for managing this profit-taking exposure? In fact, there is a lot of thought to be had, and that's something to think about on your side by asking questions, and then you can talk to people. I know that the Discord, there have been many discussions on it, so don't hesitate to join us in comments and descriptions. You have the Discord if you want to come, where there is a community which is passionate and precisely which working on these questions. The notion of exposure is essential and really important in your investment, and a more important limit than your ability to manage your cash flow. That is to say that the ability you have to manage your risk will do that. You will succeed or not in the long term. Having objectives is one thing. Managing your risk is really the basis. Very good risk management allows you to have a strategy that will work in the long term regardless of what may happen in the market. And that's important because we're always trying to guess what's going to happen to determine what the areas of interaction are. Are we going to retest on a part of bullish acceleration before going back down, which has been the BXG for a while? Are we going to do a retest here, lower again, and then go back up there, limit, whatever? The important thing is to know how to manage each of these situations, to have a plan for each of these situations, and each time we enter a position to be aware of the risk we are taking and that it fits into our management policy of risk. And that's when I say a risk management policy, it really is a policy, which is to say write it down. Format it, put it without a word, for example, to really define the elements that will characterize your exhibition. For example, I want 5 assets. On these 5 assets, this must represent in a lateralization phase 50% of maximum exposure, or even why not 80% of maximum exposure. If ever we are in an upward acceleration, I agree to arrive at 90% of exposure and then reduce gradually to return to around 20%, because inevitably when we are in a form, we decrease from the landing when we are in this area here. Well, at this point, we're going to have an exposure which is going to be higher than here in a top, okay? in a top, we don't forget that we take profits and accumulate in the lower part, okay? Which is pretty logical. So we're going to look to increase our exposure in this area, and we're going to look to decrease our exposure here, okay? Which is rather logical because we are going to take profits here. So we are going to transfer the crypto into cash. So we are going to make profits. And then here we are going to reinvest profits. And therefore, obviously, we are going to increase our exposure by buying cryptos. And so define these rules, write them down, put them on your desk, or even print them. Why not? This is what I recommend in particular in trading strategies, especially at the beginning, to write it and print it and put it directly on your desk or above your screen just to be sure of having it and not to let go because it is very important. Risk management is just as important as a pure trading strategy for a trader. You have to understand that. And I will end with something, which is that you need to reevaluate your strategy regularly. Once again, it's like the assets, it moves, it evolves. So at this point, think every 6 months, 1 year to ask yourself the question, is this strategy still suitable in relation to who I am, to my portfolio, to my situation, and readjust. Don't consider that everything is definitive each time you readjust, and this allows you to be structured and ultimately continue to evolve according to the course, according to who you are and according to what surrounds you. I hope you like this video. If so, don't forget to leave me a like and a comment. It always makes me very happy, and we'll see you tomorrow morning at 7 a.m. for a daily See you.